to BackNine's webinar on how to sell long-term care in 2016. I am Elana Foxx. I am the LTC Brokerage Director here at BackNine, where we work hard at offering you a simple and an easy solution to help insure your clients. A little bit about me. I have been in the long-term care solutions planning market for over 15 years, and what has remained constant is that it keeps changing. So I'm so happy that you are attending and learning how to handle long-term care planning in 2016. My belief is that this year, 2016, our LTC options are better than ever. The reason I believe this is that we have created there are more product choices, there is easier underwriting options, and believe it or not, as agents, we are going to get greater compensation. My goal today is to help you get that LTC conversation started, and once started, how to find a plausible solution both financially and emotionally suitable for your client. No one wants to see themselves vulnerable. Long-term care makes your client vulnerable, but the reality is they are more likely to be in a long-term care situation than not. So let's get started at the beginning. Why and how to open up that necessary long-term care conversation. There really is only one decision your client needs to make regarding long-term care, and that is, does it make sense to use insurance to help mitigate their risk of their long-term care needs? Let's take a look at your client's risks. This might help you to start that conversation. Here's a visual you can use with your clients. The odds of them needing coverage in case of a fire claim in their home is 1 out of 1,200. The odds of them having an automobile totaled is 5 out of 1,200. The odds of needing hospitalization is 105 out of 1,200. The reality of them needing a long-term care situation, needing care, whether in their home or assisted living or a nursing facility, is 720 out of 1,200. This visual will help boil down the reality of long-term care happening within their lifetime. Ask them, how do they plan on handling that long-term care situation? There are 4 ways available to them that you can discuss. The first is family. Does family make sense to your client? If so, if they say yes, ask them. Don't tell them, ask them. Who will take care of them? Which of those family members will be willing or able to be a full-time caregiver? If the family is going to take care of them, where are they going to live? Are they going to move into a child's house? Is the child going to come and live with them? In addition to family, there is another way of taking care of one's long-term care needs, and that's the government. There is a government plan. The government plan is called Medicaid across the country, or Medi-Cal in California. You must qualify for this government plan. You may not have more than $2,000 in assets, and that situation has to exist for at least 3 to 5 years. So the question you ask your client is, 1, can they see themselves penniless? 2, if they have assets, are they willing to give it over to their children? And 3, are they willing to have their family visit them in a Medicaid facility? Another option is self-insuring. Let's take a look at what self-insuring means. In this slide, you can see the cost of care today in 2016 and as it's growing into the future. This is at a 5% compounded inflation rate based on skilled nursing facilities. In-home care is not rising as quickly. It's more at a 3% rate. So let's say you have a 60-year-old, your client is 60, and they are now realizing that it's time to address their long-term care protection. So currently, it's 2016, and let's go 20 years into the future, 2037. That is the target age when somebody does need care. It's about 80, 81, 82. So they are looking at $21,000 a month. This is the average across our country, which is $250,000 per year. Now keep in mind that the average person today needs 2.8 years of care. I don't know how medicine is going to advance and if people are going to stay in long-term care longer, but the way life is going, medicine is doing a great job keeping us alive. So if you're going to look at your 60-year-old's long-term care needs when they're 81, they will need somewhere between 2-3 years of finances available, monies available for their long-term care needs, which is going to bring you up to $250,000 per person. That is what is involved with self-insuring. Are they willing to face and save for this type of cost and need? So the fourth way is to look at insurance. And that's your job. You're their advisor. So let's take a minute and look at what insurance is anyway. What is insurance? Insurance is a way of protecting one's hard earnings and their retirement. Ask your client what kind of insurance protections they have. Do they have health insurance? Just catastrophic? Or do they cover for a greater risk of cost? Do they have car insurance? Of course they do. It's mandated. But ask them, do they have the minimum or do they have greater coverage? Ask them if they protected their income. Do they have group disability coverage or individual disability? That might even open up a conversation for you to help them cover their income protection. Ask them about their home. If they own that home outright and the bank did not require homeowner's insurance, would they not have protection? Then, of course, life insurance. Do they need life insurance? Who are they protecting? Are they using it to cover a premature death? Are they using it as another way of handling retirement income? They have done a great job protecting themselves. However, you're having this conversation about long-term care. They have a broken funnel. There is a way that long-term care, their earnings and their retirement can come funneling out. So have you thoroughly protected your client? Have the long-term care discussion. Now, the beauty of long-term care compared to other insurances is that long-term care plans are extremely customizable. Your job as their advisor is to give them the options and help direct them to fulfill their concerns. On this slide, you can see that there are various customizable factors. Are they concerned about inflation protection? How young are your clients? Are they 50? Are they 70? Based on their age, will help direct you into what type of inflation you need to incorporate in your plan. Would they like a limited pay? Are they young enough that they would like to pay it off in 10 years and not worry about it in the future? Do they have a business that they can write it off and take tax advantages? Are they in a situation where they do not have discretionary income, but they need to use their savings? So there is a way that you can help them use their qualified money. At the bottom of the wheel, you can ask them. You can see at the bottom of this chart, international coverage. Some people intend to live outside of the United States. Ask them these questions. It will help discern what type of product you should use to solve their long-term care needs. If they're a couple, does it make them feel more comfortable knowing that they have the ability to share their benefit? Statistically, 91% of all couples, there is somebody in a long-term care situation. As we go up the wheel, some people want to know if they can just use their housekeeper or a friend to take care of them and get paid. If that's a concern of theirs, then we have a solution for that situation. And you also have the individual who wants to know that they're paying premium, and if they do not need long-term care, they still get a benefit. Then we would go to the life insurance product with long-term care capabilities, so it's a guaranteed usage. If they need long-term care, they get a benefit. And if they don't need long-term care, then they get to pass on a benefit to the next generation or whoever the beneficiary might be. We have worked on helping you be able to find the correct solution for your client. This is our BackNine long-term care product map, and based on your client's health and their concerns will help guide you where and what product you should be looking at. We've created an axis based on how healthy they are, that's the vertical axis, and then are they more concerned about long-term care or making sure they leave something to their beneficiaries, that's the horizontal axis. So if you, let's go through the different quadrants and I will help ascertain the focus of each of these products and help guide you into making an appropriate solution for your client so that both you and your client find what is appropriate and beneficial for them. So if your client has pristine health, obviously the whole map is available to them. If they are concerned about keeping up with the cost of care, with inflation, the traditional long-term care is appropriate. If they want to take tax advantages and they have a business that they can write it out of, long-term care is appropriate, traditional long-term care. However, if they are a person that wants to make sure that they definitely get guaranteed usage of their coverage, then life insurance with long-term care rider, as you can see in the upper quadrant, is available to them. This too is customizable, but not with all the features that a traditional long-term care has. So keep in mind as we go through these products, the traditional long-term care is more customizable than the others. When we move to the right, life insurance with chronic illness, that is for the individual that might have some health issues, so the underwriting is less stringent, but they still get to use their life insurance benefit while alive to take care of them. So let's take a moment to look at the difference between long-term care rider versus a chronic illness rider. This comes up quite frequently. A long-term care rider means they can use their death benefit while alive if they are in a long-term care situation, which means 90 days or more needing care, and they can get better. Example, you broke your back, you need care for a year, you are going to recover. Then you have long-term care benefits. However, that same situation, if you had a chronic illness rider, that you would not qualify because you are going to get better. Keeping that in mind, most people in a long-term care situation do not get better. So chronic illness riders are very applicable. So if you're suffering from Parkinson's or Alzheimer's, or if you had a stroke and you're paralyzed, you are not going to get better. So a chronic illness rider would pay for your care. And if you go to the very far right, traditional life insurance without a rider, then there is no benefit while you're alive. So my question to you is, why would you offer that to somebody as opposed to life with chronic illness, or even on the line, life insurance with accelerated benefits for terminal illness? So keep that in mind when you have this conversation with your client. Below the horizontal line are 3 other possible solutions: less stringent underwriting. One is linked benefit. This is where there is underwriting for your long-term care qualification, but there's a higher benefit towards long-term care than there is towards life insurance. The greater emphasis on how much monies are available for care compared to the death benefit. That is for the individual who wants to make certain that they get some benefit from their premium, but we want greater emphasis on their long-term care concerns. Then there's the annuity with the long-term care rider, less stringent than life insurance underwriting for long-term care, and it allows them to double or triple their income when they have a long-term care event. On the bottom right corner is the annuity maximizer. No underwriting. You help your client create an annuity, and when they need care, they get a double or tripler for a skilled nursing facility. And we have a description that we can send to you. So let's look at a visual. This might help you while you're sitting with your clients. When you combine life insurance with long-term care, you turn the death benefit into a living benefit. Then the long-term care benefit is dispersed from the death benefit dollar for dollar. In fact, you can create one life insurance policy for 2 people. A married couple can have long-term care benefits simultaneously taking from that death benefit pool. Another advantage of doing that single second to die policy is that they get to age average. So you have a 70-year-old married to a 50-year-old, that happens, and that 70-year-old now becomes 60, good for him or her, and they now get a better rating than if they had applied on their own based on their age, a lesser premium. And when you combine life with long-term care, you are guaranteeing your client that they will always receive a benefit, either for while they're alive or for their beneficiaries. In fact, with this type of product, you can even use qualified money. If that is the situation, we'll discuss what's appropriate and the percentage of their qualified money that makes sense to turn into a life with long-term care. And the beauty of using qualified money, as you might know, if they were to pass away, that qualified money is taxable to their beneficiaries. However, if you turn that into a life insurance product, that death benefit comes to them tax-free, the beneficiaries. And while they're alive, the long-term care benefit comes to them also tax-free. So here's a visual. Your client pays their premium. They create 2 options. They can either have life benefit or a long-term care benefit. We create a certain percentage of that pool that comes to them monthly. And once that pool is consumed, we can add a rider. We have choices. We can add a rider that doubles the death benefit, so they get another pool equal to what the death benefit was. And we can even add unlimited long-term care benefit. These riders are very price appropriate and might really be a great solution for your married clients. And of course, any portion of the death benefit not paid for long-term care goes to the beneficiaries. So here's an example. You have a husband who's 58 and a wife who's 52. These are their needs. They know they want long-term care coverage. The wife has experienced her own family having a history of Alzheimer's. She wants unlimited long-term care. The husband, however, says, I just want to make sure if I'm paying these premiums, I get something. What if I never need long-term care? And he says this because in his family, his parents passed away quietly in their sleep. They never needed care. So here's the solution. They purchased a $200,000 death benefit life insurance policy, second to die, that can use long-term care for both of them. He satisfied his wife's concern by giving her unlimited coverage. She's concerned maybe she's going to have to take care of him for a long time. Or she's concerned that I don't want my children taking care of me for a long time. I want to be able to know that I have monies coming in so that I am not burdening anybody. When you combine the life insurance with the unlimited long-term care rider, their annual premium for the two of them was $6,000 a year for unlimited funds. They get $8,000 a month per person to last their entire lifetime once they have a long-term care claim. And of course, if they are fortunate enough not to find themselves in a long-term care situation, they get a $200,000 death benefit towards their the next generation. So here you see again the $6,000 in premium, annual premium, created a $200,000 death benefit or unlimited long-term care, up to $8,000 a month per person as long as they need it. Let's look at another situation. Here's an individual who only has qualified money. She's married, she's 65 years old, and she has done a great job of saving with she has gains of over $100,000 in her IRA. So by creating one of these plans, she is now leveraging tax-free long-term care benefits. We could put her in a life with long-term care using qualified money, where she starts out with $354,000 of long-term care benefit from that $100,000. She's going to receive tax-free monthly a little over $5,000 a month for her long-term care needs. By shifting that $100,000 from her IRA into a life insurance policy, she now gets a tax-free benefit for her beneficiaries of $165,000 as compared to the taxable event of inheriting that $100,000 in her qualified plan. And in addition, if she changes her mind and she needs that $100,000, she can get full return of premium. So there is really only one question you do need to ask your clients in 2016. If they have not allocated any of their money to their long-term care protection, are they comfortable allocating all of their money to long-term care? I am so happy to be able to provide you with any of these materials: the cost of care, the long-term care product map, the taxable advantages of long-term care premiums. I would love to send to you a medical profile to help you screen out your client's needs. The way I begin is the first step is to use that medical profile so you set you and your client up to be successful. Once you have determined their medical health, then you go to the long-term care product map. Give me a call. We will work together to find the successful solution, and you have done a great job as their advisor. The reality is, if you do not bring up the long-term care conversation, you have not done your due diligence for a tsunami that is hitting our population. And thank you for your time. Here is my number. Here is my email address, and I look forward to assisting all of you. We will be sending you a copy of this presentation along with materials upon your request. Take care.